With me now is Paul Hickey. He's the co-founder of Bespoke Investment Group. Paul, it's good to see you. So do you think expectations were really that high? I mean, or were they too low? I'm confused. Sort me out here.
Yeah, it depends what your reference point is. But coming into earnings season, what we saw the pace of positive revisions to negative revisions. The spread was one of the highest we've seen heading into any earnings season in the last 10 years. And what you typically see when you have this high expectations or an increase in the number of companies where analysts are raising guidance is it sets the expectations bar pretty high and then setting things up for disappointment. And then what we've seen so far this earnings season, despite the very strong beat rate in terms of EPS and revenues and even raised guidance, that they haven't been strong enough to exceed these high expectations. So I think, we have all these factors coming into the market all at one time. And I think earnings season is one of the major ones here that is impacting the market. You could say it's COVID or the lack of a stimulus, but I don't think it's much of a surprise that the peak of the S&P 500 off the September rally was on October 12th. And that was the day before the big banks kicked off earnings season. So there's been a bit of a sell the news reaction here, I think, and it's hard to dismiss that.
Shepard Smith here. Thanks for watching CNBC on YouTube.